Today we are joined by global economist Andrew Hunt of Andrew Hunt Economics, an independent firm based in the UK which provides macroeconomic analysis for select clients in both the financial and commercial sectors. Prior to founding Andrew Hunt Economics in 2001, Andrew spent over 12 years in Europe and Asia as a chief economist advising both the board and asset management divisions of the Dresdner Bank Group and the equity asset management division of the Allianz Group. Andrew was recently appointed as economic advisor to Clearway Capital Solutions and has worked with members of the Clearway Capital team since the late 1990s.
The Federal Reserve and the Department of the Treasury, by managing their debt issuance relative to their spending, which they've got a fair amount of leeway in matching debt issuance to the deficit. They can draw on their cash reserves, and typically people do draw on their cash reserves during conflict. But in the last 3 weeks, the combination of the Federal Reserve's buying bonds, but we mustn't call it quantitative easing, and the Treasury's cash management operations have added about $185 billion of liquidity to the US financial system. So you've got the increase in the oil price, which is a transfer. Essentially, it's a tax. It's a transfer of household and business income in Australia, New Zealand, UK, wherever, to the oil producers, who'll probably now spend it on air defense missiles rather than recycling it into our capital markets. So there's a kind of loss of income there. There's disruption. I know we're all focused on whether we'll be able to buy diesel in 3 weeks' time and all of that, but there's already a lot of disruption. Talking to some of my real world company clients, one in particular is in the hydrocarbons, or tangentially in the hydrocarbons business through plastics and stuff. You just simply can't get certain specialty chemicals at all at the moment, so you're stopping production. Now, he happens to make seats for Stadia. I think he did the Melbourne cricket thing, and got a couple of other things down there. It's a big company, and they can't get the additives they need. You're already having to postpone projects. There's already a hit to profits. So I think markets are probably underestimating the amount of damage, and perhaps there's a bit of complacency about the Straits of Hormuz. I'm no military expert, but it strikes me you've got 100 square miles from which you can launch a missile at a ship, let alone mining and it's going to be pretty hard to suppress all that. But what do I know? But there are real costs. I think markets are probably underestimating it. But at the same time, we have this massive injection of liquidity, a belief in TACO, and even that old rather tasteless maxim that you should buy when there's blood on the streets in a financial market sense. So I think that's why equity markets are proving remarkably resilient in the face of this. It's just somebody's chucked a load of money into the system, and it's not just the Federal Reserve. We know the People's Bank of China is doing $250 billion of foreign exchange intervention every month at the moment. Now, that's a lot of demand for bonds. That funds a lot of budget deficits. Governments are spending that money, so the money comes into their economy. Some of it will find its way into financial markets. We've also got the prospect of lower short-term rates. I know this doesn't apply to Australia, and I think globally Australia is very much a special case, largely by virtue of its population growth. But I think there's a fair number of market forecasters now, commentators, remembering what happened in the first Gulf War. Central banks steepened the yield curve, which itself generates liquidity by getting banks to ride the curve, by cutting short-term rates. Even places like New Zealand, where the central bank initially raised interest rates because inflation was above target, ended up having to cut them a lot shortly afterwards when the economy fell over in a heap. So I suspect markets are relatively sanguine at the moment because we've got this liquidity, because we've got this expectation that central banks will cut rates. Now, that is, I think, a question mark. When you talk to central bankers, they're acutely aware that they mishandled 2021, 2022, which was a disaster for central banks, not just in a mechanistic sense of their models failing, but denying inflation was a problem, that it was just temporary, and then having to admit that it was persistent has scarred them. And I think that does give them a bias towards tightening. So we're seeing some of this tightening rhetoric, which the market's looking through at the moment. Perhaps shouldn't. Perhaps more central banks will be tempted to follow the RBA. Is slightly worrying, as I say, understating the true impact. But I think we will see lower short-term rates in the States, that Walsh will do what he has probably put in his manifesto to Trump to get the job in the first place. But I don't think he'll be able to shrink the balance sheet. I think the Federal Reserve, if anything, is going to have to do more and more quantitative tightening. But to me, the big question for markets is less about the Gulf. It's more about what China does next in response to what we're seeing, this US overreach. So the US household sector hasn't been saving much. The US corporate sector is cash flow negative. And problems in the private credit markets are, I think, creating a problem for companies. I'm kind of unusual. I did a podcast earlier with a IFA, a financial planner up in Auckland, and he wanted to get me to say that we've got the beginnings of the next global financial crisis with these problems in private credit. And actually, I think at a micro level, the private credit thing is actually a relatively minor story. There's no systemic financial crisis there. But where I think it matters is that the US corporate sector is now cash flow negative, almost as much as it was prior to 2000, so in the boom of 99. And the biggest single source of external funding to cover that deficit, even in AI space, has become private equity and private credit. And those two are kind of interrelated now, not least of all because the companies are interrelated, and the amount of credit that private credit extends to private equity. But I think the cessation of capital mobilization through those private finance channels will be causing some discomfort. And I can't tell you which bank, but I was talking to the chief risk officer of one of the big money center banks, and he pretty much indicated they were being overwhelmed by, in some cases, surprising names, putting their hands up and saying, that credit line that we negotiated years ago, we've forgotten about. Can we have it? And I think that's probably one of the biggest signs of the problems in private credit. And we've seen the headlines about haircuts on collateral and the like, but I do monitor very closely the lending by the big US banks to other financials, to other banks, and to non-bank financials. And despite that $180 billion injection by the Federal Reserve, that data's absolutely collapsed. I think if I was to, let's be a little indiscreet, I think for Wells Fargo, Citi, and Bank of America, that reduction in lending is, oh God, we're about to step on a landmine. This stuff isn't worth all that we thought it was. So I think it's not just the headline story for private credit. There's all sorts of things swirling in that. There's good stuff in private credit, but there's also some cowboys, and there was such funds flowing to the sector. Some things got purchased that perhaps shouldn't have been purchased or shouldn't have been purchased at that price, and we're unwinding some of that. I did a paper back in January that suddenly I've had a few repeat requests for. People always say private credit grew because banks were regulated out of conventional lending, and that's true to an extent. But there was also, why was there so much demand for this stuff from the university endowments, from the pension funds, and most of all from the insurance companies? And then it became a wider client base. And that goes very much back to the pandemic. We tend to think of the pandemic as creating lots of government debt. And obviously there was, $5 or $6 trillion of public debt per annum created in the developed world. But the central banks actually bought so many bonds, and commercial banks also bought bonds in that period, that net the pandemic reduced the stock of outstanding sovereigns in the OECD by almost $2 trillion. And that left the insurance companies and pension funds obviously needed this stuff for their ALM, searching around for something that had a yield that appeared safe. And I think that was a big driving force into private credit. It certainly created this demand that outstripped, shall we say, prudent supply. And now perhaps we're paying for some of the unwise stuff that was done. And don't get me started on venture credit, which is my favorite little hobby horse. On total circle your wagons on that one. We tend to think of China as being a country that exports deflation. And that's hugely true in goods markets. We've all seen the collapse in TV prices and EV prices lately and all of that stuff. We know that China exports goods price in deflation. But I think a lot of people, and this is something I've been writing about a lot, and I'm just starting to feel like I'm getting some traction with it, is that China's exported inflation through its capital account. If you've got a $1.2 trillion current account surplus, US, you have to export an awful lot of capital to prevent your currency going to the stratosphere. And so China has bought a lot of bonds. It has bought a lot of private credit. It's bought a lot of equities. And of course, it's bought a lot of property, not least of all in Australia. And in that sense, China has exported inflation to capital markets, to property markets, and to the cost of living, particularly to non-traded goods. Remember, a lot of central banks talking about non-traded goods price inflation at the moment. Well, China's capital flows into property markets that increase your cost of living. China's capital flows into currencies that force central banks to keep interest rates low, that allow domestic credit booms to continue, particularly before the global financial crisis. China's exported deflation in goods, but inflation in services, in property and non-traded goods. And that really is a reflection of the type of economic model that they ran. China was not profit maximizing. China's an output maximizer to maximize employment. And because it produced more than it could possibly consume in that output maximizing model, it had to shift goods abroad. It had to run a current account surplus. And so it ended up with this big stock of foreign assets. It's rising foreign exchange reserves, and you can see the rate there is accelerating. But also the Chinese private sector probably has $4 or $5 trillion, maybe $6 trillion of foreign assets, which is an interesting topic in itself, because officially the Chinese private sector has no foreign assets in the data. They've systematically underreported that data. And this has a real historical resonance, I guess, going back, essentially hundreds of years. So if you forgive me a little segue here into long-term history, but I think it does have a relevance to markets in the near term. 1630s, Dutch Golden Age. The Dutch have a huge current account surplus. They recycle the proceeds of that into the City of London. That's what gives London its financial centre. The tulip bust comes, the bubble comes and busts. The Dutch have a financial crisis, stop the capital outflows, UK has a depression. Same happens in the 1860s. The UK's got a big current account surplus. It's recycling it into the Americas, North and South. Barings crisis Mark 1, the outflows collapse. The worst depression in North American history occurs in the 1870s because of that. 1920s, the Roaring 20s, the US has its big current account surplus on mass production. 1929 crash, the capital flows from the US, recycling its current account surplus into Europe, stop, and Europe descends into all the bad stuff. Question is, does China's property bust at the moment mean that China will stop exporting the capital that has supported Western asset markets, funded the US budget deficit, funded the basis trade in bond markets? Now, that I think is actually the biggest risk to the long end. And the oil price sort of is part of that, and the Gulf in a direct economic sense. But also I think we're seeing this US either overreach or expansionism, depending what you think. What response does that come from Beijing? Because I think Beijing is now holding most of the cards certainly at the long end of markets. Because China's economy, and let's to go to something more conventional here, China's economy in the midst of a five-way hit. Property prices are continuing to fall. There is a balance sheet recession. Household credit growth is zero. I mean, the charts just overlay exactly on what happened in Japan a generation ago. And if people are saving to repay debt, they're not spending money. That's a cash flow hit to the Chinese corporate sector. Weirdly, you've got a fiscal tightening in China. Nobody really knows why they're doing it. Probably dogma, but they have tightened fiscal policy over the last 6 months. They are exporting more, but at falling prices. Deflation is bad for corporate cash flow. And then at the same time, you've got, because of the crash in the property market, a banking crisis in China that makes credit much less available. So the Chinese corporate sector is really facing a number of hits here. We've got this fiscal tightening, fiscal policy has stopped easing. The Bank of China domestically is doing quantitative tightening, not quantitative easing. Crucially, Chinese households no longer trust the banks. We've got a rise in people's holdings of cash. They won't hold demand deposits. They'll hold savings deposits or they'll hold cash. And for the banks, that's a big increase in their effective cost of funding. People worry about the capital adequacy of Chinese banks, but it's not a capitalist system. They falsify the data on that one. But what the Chinese banks can't avoid is that their cheapest funding, demand deposits, are literally walking out of the door in favor of being held as cash under mattresses and in safes. That limits the ability of China's banks to create credit. It's got to go somewhere. So the mattress becomes a cheap quote. I have actually heard there's a physical shortage of safes. And that's very much my approach to this kind of stuff, is you look at the data and then try and find some corroborating evidence out there in the real world. Households not spending, the deflation, and then banks not stepping in to fund what is now a widening cash flow deficit in the Chinese corporate sector means that Chinese companies who've got those $5 to $6 trillion of offshore assets are just starting to repatriate. And you see that in a variety of data. I've got this prototype flow of funds for the Chinese external accounts. That's data that we try to compile using PBOC data. But also you start trying to look for corroborating evidence. So the US tick data on capital inflows, it's a bit late, but it turns out Cayman Islands is very interesting. The Cayman Islands have seen a big slowdown in capital inflows. Which is probably from China. I spent a lot of time with somebody I do some work with, tracing Chinese money that would come out of China into the Hong Kong financial system, moved by a Hong Kong bank into their Cayman Islands subsidiary, then out into the Cayman financial markets and into US treasuries from there. So you look at the Cayman Islands and what's it, 50,000 people or whatever it is, own $2.5 trillion worth of US treasury bonds in theory. Probably not. It's all these it's all these smoke and mirrors. But what we're seeing pretty clearly is that China's private sector is repatriating a much bigger share of its export receipts. Maybe some people are actually repatriating money. You see it in the Auckland property market even, that there's much less China money around. So again, anecdotal evidence tending to back up this data. And that, at one level you could say, is this like Japan in 1995, when the domestic problems in Japan led to the Japanese repatriating money? The yen went to 80 very quickly. Bank of Japan was forced into intervening, and it was all part of the Japanese balance sheet recession. And you can say China is just repeating that. But China today is much more important than Japan was even in the mid-90s. Is it actually getting close to that rather indulgent slide I showed earlier of the effect of the tulip mania on capital flows to the UK, the Barings crisis on capital flows to North America and 1929 in Europe, that if the problems in China force the Chinese private sector to repatriate money, then they'll pull money from the West, the long end sells off in global markets, and Then you've got mortgage problems, you've got solvency issues in the corporate sector, you've got fiscal sustainability problems in governments, and pretty soon you start to think the West has a bigger problem than China does at this point. Now, where it's different this time, and that's not a phrase economists should use lightly, is as the Chinese currency started to appreciate, the authorities decided that was bad for their economy, and we've seen this massive intervention program by the PBOC. And I think the ultimate question for financial markets, and this is almost, do we have a global financial crisis because of private credit? No. Do we have a global financial crisis because of a higher oil price? We have a recession, but we get lower rates. That's probably not a crisis either. I think the big question for financial markets is, what does the PBOC do? Does Xi Jinping decide to stop intervening? But there has to be a non-zero probability that Beijing reacts to global politics by sending this guided missile, I guess, into Western bond markets by revaluing CNY. So what I'm saying at a very top-down level to clients at the moment is central banks, certainly the Federal Reserve, is reacting to the oil price shock in the way it did in the early 70s and Gulf War One. They're easing into it. They're accommodating the rise in the oil price to try and protect consumption, protect financial markets. That should be inflationary over the longer term. And if you think about it, the US has got a widening budget deficit that they're now monetizing in a fully employed economy that was already having some problems with inflation. So I think your 80% bet is that monetary policy eases. Markets kind of initially are okay with that. Perhaps there's bad days, there's good days, and perhaps there's slightly more bad days than good days, but it's not a big event. The central banks react to the global weakness by easing, even if that brings us inflation over the longer term. But I just say that where it is a little bit different this time to even 73 and certainly to the first Gulf War is China's rise in importance. That if that dozen or so people at the top of Chinese policymaking, whose prime objective is reunification with Taiwan, decide that there's an opportunity to create some mischief in US financial markets at a time when the US looks like it may have miscalculated the Gulf and overreached a bit. That is a non-zero probability. So as a hedge, there's perhaps a long in CNY. Might not yield anything. It might even cost a little bit of money. But it does provide, I think, some possible protection to China deciding now is the moment to detonate a geopolitical bomb by cutting that intervention. And I certainly think US markets would be vulnerable to that. People, I think, have forgotten the US capital account. This time last year, we were all worried that Trump being president, money wouldn't flow to the US. There'd be a strike by US donors. And actually, when you look at the data, and we've now got a lot of data for capital inflows into the US last year, they were the fifth largest in history. Probably sucked in by private credit. And that allowed for markets to get expensive, for real yields to be very low. I think if those capital flows now stop, either because the US has just, for a better expression, pissed off so many of its allies, or China spots an opportunity to create mischief, you would see a sharp rise in real yields, which would expose market valuations. So that's actually my tail risk at the moment. And it's perhaps a bit more than a tail risk in that I'm giving it a 20% probability that China revalues its currency. And that would have a very detrimental impact on liquidity pretty quickly. Higher yields, capital rationing in the US, worse problems in private credit. That positive output gap in the US that I talked about will disappear. Now, that will close the current account deficit and remove the US's need for foreign funding, but it would be painful. It would be a recession. One of my banking clients asked me to do sort of scenario analysis on what if capital flows to the US stop completely. I ran my model and came out with a 4 to 5% fall in GDP. They ran their model and came out with an 8% fall in US GDP, which I thought was a bit excessive. The mechanism: weak dollar, weak household incomes, weak spending, higher real yields, and a credit crunch, particularly in private credit, which would, of course, fit back to that historical thing I referred to earlier. Now, I don't think we get a total evaporation of capital flows, but we could certainly see a significant reduction if the PBOC pulled back from intervening in the dollar or CNY dollar at the moment. So that's my, when people say, is there a global financial crisis because of the oil shock or because of private credit? My answer is no, but this is how you could get one.